Welcome to Trade Ideas. I'm Jake Merl, sitting down with Michael Guide, portfolio manager at Pension Partners and author of the Lead Lag Report. Michael, great to have you back on the show.
Pleasure, thank you.
So you were here in both March and April making a pretty courageous call on the S&P. You said stocks were due for a spring crash, and those are your exact words, and you said the word crash. You said the market could retest its December lows, and your thesis started to play out. We sold off to around 2730 or so, and then right on cue, the Fed came in, and we've seen this rally back to 2900. So given the recent pop, has your spring crash thesis changed at all?
So let's kind of revisit the entire argument. I was making the case you'd have a spring crash, really based on a few things that were happening at the time I was talking. Right? One was lumber, which had been notably weak, and funny enough, after that segment I did with you guys last month came out, when I was really emphasizing lumber, everyone seemingly on Twitter, tweeting me at Lead Lag Report was referencing lumber, and a lot of people were showing historical relationships that did validate the idea that lumber weakness tends to precede, periods where markets tend to collapse or break down significantly afterwards. Utilities are strong. We've seen the yield curve all over the place, not just in the U.S. but overseas, not just collapse, but in some cases invert. And I would argue to you that if you were a Martian coming from outer space and you didn't look at stocks, and you saw that bond yields were pushing at the 10-year to almost under 2%. You were seeing some inversion of the 3-month, I think, in the 10-year. You were looking at negative rates, getting more negative. You'd probably say market probably already did crash, right? The only thing that didn't get the memo, of course, was the S&P so far. Now, I still think there is a real risk. I think the risk has lessened. And I think the risk has lessened because right on cue with that very poor jobs report and all the global PMI manufacturing data, which is getting worse and worse, forcing some rhetoric changes from the central banks, you may now have a situation where there's a panic move by the Fed. Panic move meaning what we're seeing now, all this talk about the Fed cutting rates as opposed to hiking rates. Cutting rates, I think now the expectation is 3 times this year. No different than the Pavlovian dog's response to the bell. That alone could cause some kind of residual, bullish movements here, buying. That probably explains why the S&P is up 5% in 5 days, why you're now back towards the highs, at least on large caps. You haven't seen that on small caps. You haven't seen that in emerging markets. A lot of other weakness is still there. Something is still ridiculously wrong, though, right? Because the fact that we're even talking about the Fed cutting rates with the unemployment rate at 3.6%, I wish people would step back and just say, how fragile must we be if you can't even handle a momentary blip in the economy or momentary blip in markets, that it results in monetary policy changes that are longer lasting than the now, right? So there is something I think that's very crazy with the way the rhetoric is playing out here.
So lumber is still weak, small caps are still weak. We see bond yields still down low near the 2% level. Do you think stocks are still going to crash?
Look, when you have this kind of behavior, I think there is absolutely a possibility. Now, there are always false positives in every signal. I talk about this all the time on the road. There's nothing that's a holy grail. You have to, at the end of the day, slow down entering a storm. You hope that the crash doesn't happen. You get to your destination slower, but you got there safer. So the question then becomes, well, if you don't have a crash, what happens? And I think that there is a possibility that if that scenario has played out, that you don't have that now or never moment, that markets don't really break down further from here, that probably emerging markets are the place to be. When you look at emerging markets relative to the S&P, around mid-May, actually, that started to stabilize. In other words, you started seeing emerging markets keep in pace with the S&P as all this trade war talk was happening. So it seems like there might be some kind of leadership shift happening there. And I suspect that the dollar is due for a pretty meaningful decline. I think a lot of what's happening with this rhetoric around cutting rates is really more about trying to target the dollar, try to cause a depreciation in the dollar as these trade wars continue. Because as much as you may want to put a tariff on some country, at the end of the day, if the currency adjusts by the same amount of the tariff, then net you haven't gone anywhere, right? So I think that there's some argument to be made that the dollar is likely to be weak. That may be why you're starting to see gold rally strongly, because dollar-denominated assets would benefit from a weaker dollar. Maybe why you could start seeing some movement in broader commodities and reflation trades. Again, all this is hypothetical. These are just starting to show sort of the whites of the eyes of some trend changes in those areas.
And what would be the catalyst, to get those higher?
I mean, it could very well be just we've seen that sometimes the most powerful monetary weapon is not interest rates, but it's words, it's talk. I am certain that the Fed knows what words at what time to release into the marketplace for algorithms to just jump on it and create a self-fulfilling cycle of some kind of trend. So it wouldn't surprise me if it's just purely discussion that starts the trend lower in the dollar that then has all these kind of other knock-on effects. But I will maintain what I said. Bonds still suggest there's some severe risk here, right? So tread carefully either way.
So you mentioned emerging markets. Are you bullish on emerging markets on an absolute basis or just relative to the S&P?
Yeah, look, absolute and relative get to be the same when your relative is high enough, right? In other words, if the relative outperforms emerging markets is 2,000 basis points, it's 20%, right? That's a pretty big absolute move too, most likely, right? I just think that there's so much negativity towards emerging markets. And listen, emerging markets have been dead money for over a decade. Talk about volatile cash like this. It's been the worst investment from an opportunity set perspective relative to, obviously, U.S. markets, right? At some point, hopefully that will change, hopefully. Hopefully in my lifetime, emerging markets start running. But I think, from a contrarian perspective, you start saying, well, there's so much negativity towards emerging markets. People are assuming that all these trade wars are only going to affect them negatively. Maybe there is a positive outcome, and maybe there's some kind of potential investment to be made there.
And how much outperformance do you actually see?
Yeah, interesting question. So, look, we've seen historically when emerging markets run, they run pretty strong. And it depends, obviously, on your time frame. When emerging markets are this compressed, they can converge against large caps fairly quickly. Emerging markets, when you look at them on a weekly basis, can have 10% moves. If you look at EEM or VWO or some of the other emerging market ETFs. So if it were to happen, it probably could happen not only very aggressively, but maybe 1,000, 2,000 basis points against the S&P, just a catch-up trade, effectively.
So it sounds like you're saying there are two kind of binary outcomes. Yep. You could either have the crash you were suggesting could happen last time, or we could get this reflation trade due to the Fed easing, the Fed dovish pivot, and therefore you should be short the dollar and you should be long emerging markets. Is that right?
Yeah, and I know that sounds like I'm talking from two parts of my mouth. But I don't think the two are unrelated, and I'll use some history for that. Go back to 1999. Greenspan lowered rates because he was concerned that Y2K was going to cause a crash. So he liquefied the markets. And a lot of historians will argue that was what ultimately caused the true blow-off and move in the tech bubble before the collapse. So it could very well be that, given that lumber has been correctly telling you that there's weakness in the economy, we're seeing that. Given that utilities have been telling you there's weakness in the economy, we're seeing that. Given that treasuries have been rallying, telling you weakness in the economy, we're seeing that. The Fed overreacts, causes a tremendous amount of liquidity rush suddenly to avert the crash that could be coming because these other areas are telling you to be careful, and then cause a blow-off move. It is very possible that is the scenario, that the central banks create an overreaction to the potential of things really breaking down meaningfully.
If the Fed were to cut rates in the coming months and stocks do rise, wouldn't that be a long-term kind of sell signal? Wouldn't that kind of signal the top?
Yeah, this one's always kind of curious to me, right? People always say, don't fight the Fed. Well, if you don't fight the Fed, then why did we ever have any bear market to begin with when the Fed had rate cutting cycles? I don't think a lowering of rates is ultimately going to do anything for the economy, right? Let's go back to lumber. Lumber is tied to housing. Housing is tied to the 30-year mortgage rate. It's clear that cutting rates is not necessarily causing the long end of the curve to respond, right? The 30-year, which is tied to mortgages, which ultimately will drive housing activity and drive lumber demand. How is cutting short rates going to help with that? The only thing we've really seen from the Fed in terms of effectiveness is asset purchases, is the balance sheet expansion. That's a very dangerous thing if they start to go back to that. Because again, then where does it ever end?
So I understand that the rate of change for the Fed funds from 25 bips is one of the greatest in history and that we have tightened significantly. But unemployment is 3.6, and there are some other factors that suggest, why are we cutting rates now? And it kind of suggests that the whole monetary experiment from 2008 was a bit of a failure regarding quantitative easing and ZIRP. What do you think of that?
Listen, I think there's a lot of validity to the idea that if the Fed does lower rates, it's an admission of failure on their part. And it's an admission of failure, which they don't want to do, because if they do, I think it means that we're probably in the Japan trap. Right, with all this debt, $22 trillion or so of U.S. government debt. It's funny. People always say, where's the bubble? Where's the bubble? Markets are, PE is this and price of sales. And all. Where's the bubble? The bubble is clearly in government debt. And, all this tremendous amount of easing and lowering of interest rates and normalizing rates to an ever lower level has ultimately created I think, an environment where at some point the piper's got to get paid. Right, in terms of all of this tremendous borrowing against the future. And by the way, it's not just U.S. governments. It's also large cap equities, large cap companies, which have used these low rates to ultimately buy back stock as opposed to reinvest in something that's truly productive or enhancing of growth. That's a whole other discussion of itself. I do worry that we may be entering sort of a no man's land for monetary expectations, because if the expectation was that the Fed's going to keep on raising rates, and you can't even keep doing that at this point, how are they ever going to raise rates?
So, Michael, can you please summarize your view in 30 seconds and give some recommendations how we should play the current environment?
So, again, is the risk still there of a big decline? Unequivocally, yes. Lumber still has not turned. But by the same token, if all of these signs are there and the central banks are paying attention to it, it could be an overreaction to liquefy in advance of what could be a big breakdown, and that could cause a conceivably meaningful melt-up in reflationary trades, especially emerging markets, cause the dollar to break. So I think anybody that's looking at markets here, inherently, if you're bullish, you're going to be betting that the Fed's going to overreact and actually cut, I think. If you were bearish, nothing much has changed. The S&P is probably still likely the place to target most of your attention. And if you're bullish, you want to probably bet on anything outside of the U.S. and anything that would be tied to a weakening dollar.
Well, Michael, we'll see how it plays out. Thanks so much for joining us.
Appreciate it.
So if the Fed continues to be dovish, Michael thinks the iShares MSCI Emerging Markets ETF, ticker symbol EEM, to S&P 500 ratio could rise 10 to 20% over the next 3 months. That was Michael Guyad of Pension Partners and author of the Lead Lag Report. And for Real Vision, I'm Jake Merl.